Warren Buffett, the Oracle of Omaha, has established himself as one of the most successful investors in history. His investment philosophies are not only the foundation of his own wealth, but also a source of valuable insights for investors worldwide. Here, we delve into the top 5 investing philosophies that have guided Warren's approach, along with examples of companies he has invested in that illustrate these principles. 1. Value investing. Warren Buffett is synonymous with value investing, a strategy that involves seeking out companies whose intrinsic value is higher than their current stock price. He believes that markets can be irrational in the short term, presenting opportunities for astute investors to buy undervalued stocks. This philosophy is rooted in Benjamin Graham's teachings, who was Warren's mentor. One of the prime examples of Warren's value investing approach is his investment in the Coca-Cola Company, or KO. In the late 1980s, he recognized the strength of Coca-Cola's brand and its wide moat in the beverage industry. Despite temporary setbacks, Warren saw the company's long-term potential and invested heavily. Over the years, this investment has proved highly profitable as Coca-Cola's brand endured and its market value increased significantly. 2. Long-term holding. Warren's aversion to short-term market noise is evident in his philosophy of holding onto investments for the long term. He once famously said, "Our favorite holding period is forever." This approach allows him to capitalize on the power of compounding, as well as to avoid transaction costs and the emotional roller coaster of frequent trading. Warren's investment in American Express, or AXP, underscores his commitment to long-term holding. In the early 1960s, American Express faced a crisis due to the Salad Oil scandal. Instead of fleeing, Warren recognized the company's strong brand and reputation and began accumulating shares. His patience was rewarded as the stock rebounded and flourished over the years. 3. Economic moats. Warren often talks about the concept of an economic moat when evaluating companies. An economic moat represents a sustainable competitive advantage that shields a company from its competitors. He seeks businesses with strong moats such as brand loyalty, cost advantages, or network effects, as they are better positioned to withstand challenges and generate consistent profits. Berkshire Hathaway's ownership of See's Candies exemplifies this philosophy. Despite being in a competitive industry, See's Candies has built a strong brand and customer loyalty, creating a moat that protects it from new entrants. This consistent demand has allowed the company to maintain stable profits over the years. 4. Margin of safety. Warren's concept of a margin of safety is grounded in his desire to protect capital. He believes in purchasing stocks at prices below their intrinsic value to provide a buffer against unexpected market downturns or unfavorable developments. This approach reduces the risk of permanent loss of capital. For example, during the financial crisis of 2008 to 2009, Warren's investment in Bank of America, or BAC, showcased his commitment to a margin of safety. Berkshire Hathaway provided much-needed capital to the struggling bank in exchange for preferred stock and warrants. This deal not only benefited Warren's firm, but also demonstrated his readiness to invest where there was a significant margin of safety. 5. Avoiding complexity. Warren famously advises investors to never invest in a business you cannot understand. He prefers straightforward businesses with transparent operations and easily understandable financials. This approach helps him make informed decisions and avoid unnecessary risks. For example, while Warren is historically known for avoiding technology stocks, his investment in Apple Inc., or AAPL, showcases his ability to adapt while adhering to his principles. Warren saw Apple as a consumer brand with a strong ecosystem and customer loyalty, aligning with his philosophy of investing in what he understands. In summary, Warren Buffett's investing philosophies are a blend of time-tested principles that have consistently yielded exceptional results. His dedication to value investing, long-term holding, recognizing economic moats, maintaining a margin of safety, and avoiding complexity have defined his approach and underpinned his success. Through examples like Coca-Cola, American Express, See's Candies, Bank of America, and Apple, his philosophies come alive, offering valuable lessons for investors seeking to achieve long-term financial prosperity. At ROI Roadmap, we hope that you have found value in this content, And if so, please leave us a like on this video and subscribe for future videos on personal finance and investing.